Hey traders, this is Blake Morrow with Trader Summit, and we got a little special treat today. We got Jim Welsh a day early. I'm so excited. Jim, how are you?
I'm confused. I don't know where I am. Here we are talking. I feel like deja vu set forward like 24 hours or something. I don't
Right,
know.
right. I know it's a little weird meeting a day earlier than we normally do,
Yeah,
but
yeah,
we wanted to meet just because our schedules are going to be off the next
yep,
week. But listen, we just came off a 2-day testimony from the Fed Chair Powell. Did you extract anything new from Powell that you wanted to hear, or
yeah.
didn't something that caught your attention?
Not really. I think he pretty much reiterated his comments, his statement after the meeting, and then he did his press conference. I think the one thing he clarified is that he is willing to go two rate cuts or rate hikes, pardon me. Whereas people were thinking, well, he's a little bit more middle of the road. He's on board for one, but maybe not a second. And he was asked pretty directly by, one of the Congress people. And he said, yeah, I think two increases before year end is about right. So he kind of tipped his hand that he's supportive, but overriding everything is data. And the one thing that he didn't say, he couldn't say, and we've talked about this, is you look at the projections, and they're expecting the unemployment rate to get to 4.5% next year. So inflation is going to continue to come down. In the second half of this year, we'll see core inflation come down more than it has because of the pullback in shelter inflation, as the rent data and the housing price data start to filter into the way they do those calculations. But I think he continues and has repeatedly since Brookings last November said labor market tightness. So his opening statement yesterday and obviously yesterday and today focused on the labor market still really tight. And I think they believe, as a core belief, that in order to get inflation to come down and stay down, they need to see more labor slack develop, which automatically translates into higher unemployment, which in my mind means above 4% at a minimum. Historically, whenever the unemployment rate goes up by 0.5%, which it would if it gets to 4%, the economy's been in a recession. And then once a recession kicks in, the unemployment rate is a reactive function. It reacts to that and jumps more aggressively. Yeah. So to me, that's the piece, but he can't publicly obviously say anything about, we need to see the unemployment rate tick up, and we probably need to see a recession for us to have the confidence we need that inflation is going to trend towards 2%. So.
Okay. Well, it's worth noting, and I'm glad that you brought that up today because, I think a lot of, you look at the markets have, come off the highs over this last week. I mean, the S&P's come off 100 handles. We're seeing a little bit of recovery here after, such a steep sell-off this week. But in all actuality, we're still up. It's not that big of a deal. Yeah. It's like the volatility increases a little bit as we get up in these lofty levels. But it does seem like the market's kind of like, well, all right, we've heard most of this before. And
the markets don't believe it. And more importantly, I think markets continue to believe that a recession is not going to happen. And as we've talked, I think the second half of this year is going to be where the test comes, because for a lot of reasons, I think the economy is going to show more signs of slowing, and we'll see how stocks handle that. I mean, if the S&P only pulls back to 3,900 or 3,950, and we're getting a lot of negative economic data, and the Fed is not providing any glimmer of hope that, we're going to be cutting rates real soon, because to me, that's the other important component. We'd see a period of economic weakness, the S&P would start to soften, but the Fed would continue to stick to the mantra higher for longer. And it's in that window of time where I think the market could be most vulnerable. So I think we're approaching that test over the next 2 to 3 months.
All right. Well, you always bring great charts for us to look at. So let's start off with the first chart that you brought us today. And that is of the Fed funds rate versus the unemployment claim. So what are we looking at here?
So what was done in this chart is they took the Fed funds rate and they pushed it forward 18 months. So, we always talk about the lag of economic, policy changes, and it's 9, 12 months and so forth. So what this did is basically, well, let's say it was 18 months. And now you can kind of see the correlation be changes in the funds rate, which is the dark line, and unemployment claims. And, the correlation is unmistakable. It's just a question of how quickly does it kick in. And, what we've seen is historically is the unemployment claims more often than not get to a level on a relative basis that's higher than the funds rate, but it gets awfully darn close no matter what. So the point being is you're talking about a significant increase in unemployment claims in coming weeks. And I can't remember if we looked at the unemployment claims chart, if we've done this or I've just had it in one of my letters. But to me, you look at the chart of unemployment claims, Blake, and it's very clear they've made a rounding bottom, if you will, and now we're starting to head up.
Yeah.
And people are just not talking about it, which is interesting. But to me, these are the telltale signs that the labor market is going to weaken. We've talked about and we've shown weekly hours worked and how much that's declined. I think we may have shown temporary jobs and how that's declined. So these are all the things that happen before unemployment claims start to tick higher. Now we're seeing unemployment claims tick higher. And it's just a question of, is it 2 months, 4 months? Somewhere along the line, we're going to get a jobs report that for the first time in, I don't know if it's 15 months, it's like for a really long time, that the number comes in under the estimates. So we've had this big string of months where it's always come in better. So the table's set. I just think sometime in the third quarter, we're going to see a jobs number that disappoints because the leading indicators to that outcome have already, if you will, made a call. And I suspect that's going to continue to be the case. And that's where the market starts to have to deal with, whoa, wait a second, the economy maybe really is going to slow down. And then in the middle of that, at some point in time, well, maybe we are going to get that recession after all. And that's my guess.
And the thing about unemployment claims, and I'm a study of price action in the markets, and we've seen the markets really tick up in volatility during these weekly unemployment claims as they've been missing to the upside a lot of times over the last 3, 4, 5 weeks or whatever it is.
Yeah.
And I remember the days. I'm old enough to remember the days, 20 years ago, where you'd see unemployment claims really rock the market. In currencies specifically, but also futures pre-market each and every week. And I think it does feel like that the market is starting to brace for what you're talking about, but they're not
quite there yet. I mean, think about the first week where claims get above 300,000.
Yeah.
I mean, I think they're still in the low 260s.
Yep.
So it's still, out there, but there's a number out there that will kind of like, whoa, where'd that come from? Well, it's been happening for a while. The one thing I'll point out, again, people are bullish about the economy, which I think is ironic, given where we're at. It's kind of like the boy cried wolf, except in this case, it was the economist cried recession over and over again. And now everybody's like, hey, you can ignore those guys, all right? And we're at the point in time where the wolf is at the door. And that's my feeling. So the interesting thing about, where the economy's is going to do better, going to be okay, and the market's broadening out. Folks, if you look at, and I would urge people, we didn't have time for me to put these extra charts together, but if you look at the value line composite, the Russell 2000, even the New York composite, what you can see is these averages. The New York composite, I think, is about 2 to 3% below the February high. The value line's about 5%. The equal weight S&P is down about 4.5%. So all these people are getting more ramped up, and yet technically big parts of the market are well below where they were in February. Now in February, what was the S&P? 4195. So it went up 250 points above that, and yet most other big, large, unweighted segments of the market are 4 to 5% below. That's not the kind of thing that would happen, in my view, when you were really seeing broad participation and, oh my goodness, the market's telling me that there's a recovery on afoot. I mean, just since February, broad market averages have weakened significantly. So that to me is the fly in the ointment. And one of the bulls' argument is that, hey, the market's broadening out and all that. That was true maybe in February. It's not true right now.
Interesting. All right. Well, the next chart you brought up, Jim, is of commercial and industrial loans. What is this? Well, you've talked about lending standards tightening, and is that what this is?
Yeah, that basically is what happens after banks ramp up lending standards. They stop lending as aggressively, and they actually start reducing the amount of loans. Why? Because they're anticipating an economic slowdown, which means loan losses go up. So one of the things they do to try to insulate themselves from that is when they roll over loans, they roll over less. They're less aggressive in lending. And the irony again here is we saw that dust up in terms of the small banks in March and all that, and people are looking at deposit outflows as being, well, that's really calmed down. That problem's behind us. No, the bigger problem, which you are not paying attention to, is the contraction in lending, which is going to intensify in coming months. Yeah. Because as we've talked, banks increase lending standards today. Well, if my loan doesn't come due for 9 months, excuse me, I'm not going to feel the bite from that until 9 months ago when I have to renegotiate with my bank. So this is, again, the lag time between when these things happen and how they slowly but surely impact the economy. And, I believe these things are all coming together so that in the second half of this year, we're going to see less growth. I've shown charts in my letters of, higher lending standards impact on hiring. By small businesses. Why? Because small businesses are more dependent on the banks than very large companies that can issue bonds. They don't need the banks as much. So the lack of lending permeates throughout the economy, but it takes time to really gain traction.
It really does, and you've been really harping on this over the last couple of months, and you can see it coming to fruition in full time in real time. Next up, I want to talk about the dollar, because the dollar, has kind of been beaten down here. Looks like we might be consolidating. I think we're consolidating, but we're consolidating at these lows. Are you reading anything different? I mean, do you see us bouncing? Do you see the dollar?
I still think a bounce is coming because markets disbelieve what the Fed is going to do. Yeah. The ECB obviously was fairly hawkish. Bank of England, same thing. So, again, I still think the odds favor a rally back to 105.88. But there's another pattern based on this sideways chop we've seen, where it could be a triangle, A, B, C. This recent low is a D. We're going to get a wave E. And if it's a triangle, then there's going to be another drop to lower lows coming. First, there's a rebound. So getting above the high of wave C at 104.01 eliminates the triangle. So I think the dollar's going to rally at a minimum 103, 103.75. In other words, it's going to bounce here. Now it's a question, does it have enough legs to get above 104.01? If it does, then I think it's all clear up to 105.88. So your comment kind of implies, geez, it's not acting quite as strong as expected. And I would say I'm in that camp too. And I'm trying to keep an open mind. I still think the odds favor 105.88, but it needs to kind of get going. It needs to start to show some strength.
Yeah, it's interesting. I was just referencing that chart on social media just a little while ago. Not, I don't know if it was the dollar, but yeah. Anyway, I'm looking at consolidation as well. It has been acting poorly, and I know there's a lot working against the dollar, but all we need is one scary event to happen, and next thing you know, it's a rush back into the dollar, right?
Yeah. But mainly they trade off of monetary policy, economics. The ECB is being more hawkish than the Fed at this point, but that has some negative implications for the European economy, which are not positive. Technically, Germany's economy is in a recession. It's the largest economy. I think it's about 30% of the total bloc. So there's a lot of cross currents, which I think is why we're seeing kind of this choppiness over the last 6 to 8 weeks in the dollar index. Again, I think the odds are we're going to have a rebound the quality and strength and follow through on that rebound is going to tell us a lot. Whether, hey, it's just been a corrective sideways pot, trading, got really oversold after dropping from 104 down to 100. That got really oversold. So all we've done is worn off that oversold by going sideways.
Yeah.
Or, hey, as I've been thinking, we're going to 105.88 or higher. Dollar has to prove itself. The moving averages, the red is a 5 expo, the green is 13. It's a simple trend following methodology. You can see the 5 days below the 13. We got to see that reverse.
Right, that makes sense. And what Jim was talking about as far as European growth, we have probably, as you're watching this video, was just released Friday morning, would be some Eurozone PMIs, and we have a lot of the manufacturing sector in Europe is in contraction. So just something to keep in mind as we go into the end of the week. So Jim, we got another chart. The next chart would be gold. Gold looks, speaking of weak, the gold market looks pretty weak. And if the gold market looks weak, you would think the dollar would firm up more, but gold's just kind of drifting lower here.
Yeah, it has. I mean, again, since it's high above 2000, we've been very consistent talking about a pullback, longer term bullish. Got 5 up from the lows last September. I think that's wave 1 of an advancing move that will take gold to new all-time highs. But after 5 up, you always get a pullback. So this is wave 2. How deep could it go? And, to me, one of the early targets was the 382 around 1890. And I think we're going to get down there. Under the worst case scenario, let's say the dollar does get some legs, makes it up towards that 105.88. Gold could back to wave 4 of lesser degree, which is around 1820-ish. So to me, it's just a question of waiting for this to unfold, play out, gold to get oversold. It's not there yet. And the dollar to maybe run its course. Because I think what follows later this year is a rally above 2070. As I said, a rally to new all-time highs, I think, is coming. It's just a question of waiting for wave 2 to complete. I don't think we're there yet. Gold went up 30 weeks in time. One would think 8 to 12 weeks would be a reasonable expectation. 2 months from the early May high gets you into July. 3 months gets you early August. So time-wise, that mid-July, late July timeframe would be like a 382 retracement, or almost a 382 retracement of the amount of time gold went up.
All right. Well, what's that going to do for stocks? Because the stock market, like I said, it's pulled back a little bit, but it's not like breaking the market. The market's still in a nice uptrend. Do you persist to see that happen, or do you continue to see strength in the S&P, or are you seeing this as a bigger turn?
Well, I think it's a bigger turn. I just think we have to have confirmation. Short term, that the panel at the bottom is an indicator I created called MACD on the RSI. So obviously it's gotten oversold. You can see in prior time over the last 3-4 months, typically that's been associated with low.
Yeah.
That 43.37, that's the low after the Fed's announcement on June 14th. I think that's kind of important. That's like wave 4. And so until we take out that 43.37, I think there's the potential that the S&P is going to make another move back up toward the highs. The other thing that's going to be happening is window rebalancing. So you have institutions that every quarter want to make it look like they're really smart. And so you got this viewpoint now that, the Fed's just about done. We don't think the economy is going to go into recession. And if it does, it's going to be so shallow to be unnoticeable. The Fed has told us through their projections that they're going to be cutting rates next year, which means we really got to own cyclical stocks. Okay. And so I think there's the potential that between now and the end of June that, we're going to see the cyclical parts of the stock market hold up a little bit better. The Russell has its rebalancing on the 26th. There's some other things with options activity that have the potential of putting a floor under the market. So my take here, Blake, is we're seeing the first crack in the rally. And my guess is we get a rebound that may or may not take the S&P back up to that 44, 48. But after this bounce, I think the market rolls over, and that's the time to go short, add to short positions, because at a minimum, even if I was a bull thinking, yeah, everything's going to be fine, the Fed and the economy, a pullback towards 4,200, 4,230. That's just classic chart analysis, where you broke out, you ran a bit above it, then you come back to retest before you take off on the next leg. So I think at a minimum, we're going to see a pullback under 4,250. If 4,200 gives way, then you're talking 3,950. And I think there's going to be enough weakness in the economy that the S&P is going to challenge that 3,950 during the third quarter. And if that gives way, then that opens up a lot more weakness potentially. But it's taking it one step at a time. So I think we get a bounce, look to opportunity to either lighten up more or look to go short. An awful lot of that move up from 4,250 to 44.48 was options related last week, in my view, because as people buy call options, dealers go short. As you get above strikes at 43.50 on the S&P, the dealer community is scrambling to hedge, and that means buying. And at the same time, again, you look at the broader market averages, they don't have anything like that kind of a pop. So I think it was related to the quadruple witching last Friday. But again, until people are given a reason to sell, selling pressure remains low. I think as we get into the third quarter, they're going to have some reasons to sell.
Well, you've been talking about the bond market and expecting some sort of recovery. It seems like to me, the bond market is not buying the idea that everything's rosy right now. It's holding up a lot better than you'd think. But the flip side is, a lot of the bond markets are giving you some yields at these levels. So
there's a reason to buy them.
Yeah, there is a reason to buy them.
Yeah. So to me, I just continue to think that there's one more dip down coming. In other words, yields tick higher. And ultimately, I think that we're going to see the economy slow meaningfully in the second half of this year. And that's going to be a big tailwind for Treasury bonds, Treasury yields coming down, bond prices rallying. So to me, it's just a question of trying to be maybe too precise, but I think there's a dip coming below that 100.03 that the TLT made. And that's why I'm saying, hey, buy it under 99.20. It could dip under 99.66. It could even dip under the 98.86. I just think between now and the first week of July, there's a chance that you could see yields tick up. But what's going to really, I think, determine the ultimate outcome is how much does the economy slow? And when we see that, I think Treasury yields get a pretty good bid. The other thing is that the short positions in Treasury bonds are really large. But you need something to press those people to cover. Well, that probably won't happen until you get above 110, because we've been up there and geez, it's just another chance to add the shorts and so forth. And look, and we're down to 102, 103. We're just looking for that breakdown. Well, again, if economy slows, gets out and breaks above 110, that's where the short covering will give it, the legs. In addition to people wanting to buy bonds because, yields are going to press lower as the economy slows. Ultimately, the Fed does cut rates and so forth. Just the classic business cycle pattern.
Yeah. Well, Jim, I want to say thank you for guiding us every week. I'm going to miss our meeting next week. And I know it's not just me, it's you guys and gals at home. Jump in the comments below. When do you think that we're going to see weakness? Are we even going to see weakness in the U.S. economy? Tell Jim how you feel down in the comments. And make sure you give him a thumbs up for being here every week, even on the weeks that, well, next week we won't be able to do it, but
just don't say anything about my mother. Okay. I mean, come on.
Yeah. Keep it clean. Keep it clean, guys.
Just talk about the market and the economy.
All right. Jim, what's the best way to follow your work?
Macrotides.com, or send me an email, Jim Welsh Macro at Gmail, and I'll send you a recent publication.
And tell him that you saw us here on the Traders Summit. He'd appreciate it, and we'd appreciate it as well. Yep. We don't get anything back for that, but just to know that we're doing a good job getting the information out. So, Jim, I want to wish you a good luck the next week and a half, 2 weeks, and we'll see you in 2 weeks.
All right, take care.
Cheers. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.